Hi there, Tim Pope here with a China buzzword from the ICS News Desk. In each episode, we aim to decode and explain one hot topic in Chinese business and media. Today, I want to talk about one expression being thrown around a lot in the stock markets and in the financial media, 中特估, or valuation with Chinese characteristics. This term was coined in November of 2022 by Yi Huiman. He's the head of China's stock market regulator. But it's become a red-hot topic in the last few weeks. When he first mentioned it, Yi was arguing that the country needs a new approach to gauging the market value of its huge state-owned enterprises, or SOEs. The concept of the SOE goes back to the founding of the People's Republic of China in 1949. Back then, China was a planned economy, so nearly every company was owned and run by the government. Even today, after decades of reform and opening up of China's economy, they still play a pretty pivotal role, particularly in the development of public infrastructure. He said that the very low valuations for most SOEs don't really reflect their true value. And it's true that valuations have been pretty low. According to the data provider Refinitiv, SOEs that are controlled directly by the Chinese central government trade at around 9 times earnings on the stock market. The market average is 16.8, and private companies trade at nearly 44 times earnings. So the difference is huge, and it has an impact on the ability of these firms to effectively raise money through share sales, spin-offs, restructures, or even mergers and acquisitions. Top Chinese leaders and regulators have been quoted as saying that SOEs need to be stronger, better, and bigger, and that different kinds of stocks need different valuation methods. This official urging has prompted Chinese brokerages to start promoting SOEs in a much more aggressive way to investors. The Chinese characteristics that they've been highlighting include the role that they play in key government priorities, like making China self-sufficient in advanced tech. And the Shanghai Stock Exchange has just launched a roadshow touting SOE stocks as a safe and rewarding investment. This idea might take a little time to catch on among foreign investors, though. For a long time, they've looked down on state-owned enterprise stocks because they see the firms as inefficient and because they can be asked to put China's national goals ahead of investor profits. But that doesn't mean there are no takers. Since March, around a dozen Chinese mutual funds have applied to launch new funds dedicated to investing in SOEs. Some of them are aiming to raise billions of dollars. And the drive has already seen big jumps in SOE stock prices. This year, they've turned from boring blue chips to red-hot investor favourites. China Telecom and China Mobile have both risen by more than 50% since the start of 2023. And the oil giant PetroChina is up more than 60%. If you've got a China buzzword you'd like us to explain for you, please let us know in the comments below. See you next time.